Hey, everybody. Welcome to EWO Live. My name is Jeffrey Beamer. I'm the Senior Investment Strategist over at EWOTrading.com. And welcome to our show. Today, we got lots to cover. We're going to start with a trade that we gave away last time we were here, talk about how that did. We'll get into a little bit of headline news, talk about some sectors of the market and how they're performing. Then we'll wrap it up with a trade for the week because it's going to be a big week. Let's get right to it. We are going to start with our trade from the last time we visited, and that was on Constellation Brands, STZ. This was an earnings-related trade. We were looking for earnings for Constellation to be very quiet. That turns out to be the exact case. Stock just did not react. There was a little volatility through the earnings, but no big gapping, no big moves. And as you can see from the chart there on the left-hand side, the stock was pretty quiet, consolidated after the move, and we were able to hold on to this trade through expiration and experience the maximum credit which was available. So 100% of the credit we were allowed to keep, and that turned out to be $164 per spread. Okay. Now, based upon a hypothetical trading account of $10,000, which we base it upon, that would have equated to a 1.64% return on portfolio for just a 2-week trade. Now, that doesn't sound like much, but that was a 49% return on risk. 49% return on risk in a 2-week trade that yielded over 1%, over 1.5% return to portfolio. For holding on to this type of trade through earnings. So speaking of which, let's get right to some of the headlines here. Speaking of earnings, we are at the very beginning of earnings season. In fact, Friday, I would say, was the kickoff as we had JP Morgan, Wells Fargo, BNY Mellon, all have earnings last week. Today, we started with Goldman Sachs first thing this morning. So we have over 1,500 companies declaring earnings this month. So we have officially begun earnings season for Q2, even though we're in July. They're reporting the last quarter. We have 186 companies declaring this week, and we've got our eye on 27 of those for our various strategies. All right, now something else that could be a market mover are the economic data that's coming out this week. Starting about an hour ago, maybe 2 hours ago now, Federal Reserve Chairman Powell was being interviewed by David Rubenstein. He's head of the Economic Club of Washington, and there was speculation on maybe some wording that might come out from that interview that could give the markets some direction. Tuesday, we have retail sales month over month, nothing on Wednesday. Thursday, we have jobless claims, and then Friday is a quiet day. But those events can typically impact markets as they did last week. All right, so let's move over to the charts and just kind of see what's going on here. We have we're going to start with the Spider Index Trust SPY, and you can see here today these are daily bars that we're looking at, and I'll zoom in, and we are well off the highs of the morning. And this is very interesting. We start higher, end lower, but still up for the day. That is really an indication that the trend may be ready to shift. It's not a definitive, but it could indicate a possible change in trend. And this candle, if it was clear of the previous day's wick, would be pretty ominous. But as it is right now, it's not. I will bring in my Heiken Ashi candles because I like to see trend. And here you can see that we are still in a very bullish pattern. In fact, the latest candle has no wick on the bottom. That's indicative of a big bullish candle. Now, I'll put some moving averages on here, and you can see that we are above my 10-period moving average, which is the blue line. We're above the 21 period, which is my red. And, of course, the orange is the 161, which is way down at about 508. That Spider Index Trust. So this is a very bullish still for Spider, even though the individual day candles are looking a little weak. I'll keep it on the Heiken Ashi candles as we go over to the NASDAQ because it's really the same story here. Oh, one thing I wanted to point out on Spider, in fact, the headline probably came up. We have a target of 565 on this, and we actually pretty much hit that. Let's go back to the regular candles and just take a look and see because we closed Right. No, we're getting close, but that 565 target I did not have that being hit until about October 1st. So we're probably going to hit that this week, and then we will reanalyze and adjust our targets. But we're pretty much right there. Same thing for the Qs. We had a target of $500 by the end of July. Here we are halfway through the month on the 15th, and we actually hit that last week. We hit that $500 target. This consolidation that happened at the end of June gave way to, look at this big move on the Qs, and we hit our target pretty darn quickly. So now we're reassessing. You'll notice that even with that drop on Thursday, we came right down to the 10-period moving average, not really doing much. How is this interpreted on the Heikin-Ashi candles? Well, as you can see, we're starting to get a little wicky. That is a little bit concerning. This may be indicative of a rotation out of some tech, but we'll see. And of course, that might also depend on interest rates, which we'll look at in just a moment. Okay, back to our regular candles, and we'll take a look at the Russell. Speaking of interest rates and Russells, we'll talk about interest rates in a moment, but boy, did the Russell really react to changes in that arena. We broke above and closed above a solid resistance area at 210. We did that on Thursday. We gapped up on Friday. That kind of an interesting candle that we had on Friday, but today, no bones about it. Big move, strong bullish breakout on IWM, and just look how that wedge just was almost perfect. If I wasn't so convinced that we would hit that 210 area as possible resistance on that wedge, could have definitely done something like a straddle or a strangle on IWM because volatility was low, and boy, that would have been a great payoff going into this week. So a big move on IWM as we head into the week. Moving over to some of the commodities, we'll start with USO. It is down off of its highs a little bit. We ran up to 82.5 last week. That is pretty solid resistance here for USO and for WTI, which is West Texas Intermediate, and crude oil overall. So we have pulled back. We're holding at the 21 period moving average. So I would not be too concerned about a further pullback unless we break and close solidly below this $80 level, maybe even the 79, and get below that 21 period moving average. If we do that, then we could look for a pullback, definitely down to 75 on crude oil or USO. So keep this on your watch list. A break below that 21 period moving average, and we will be dropping down to $75 on USO. Moving over to the metals, take a look at gold. Gold continues to challenge. Oh, it has pulled back. I was thinking we were going to get a breakout move closing above that 225 today, but through the morning session, you can see that candle there. Look at that. It has pulled back and now is finding resistance at 225. It's trading at 223, well, 224 for all practical purposes, and right at my resistance area, maintaining its performance in the sideways trend. Okay. Find that pretty interesting that it jumped up there. Maybe some words coming out about what Fed Chairman Powell is saying. I haven't seen any headlines to that yet as we started this session, but interesting day for gold pulling back. Now, silver just has not kind of kept up with that momentum. It is holding its 10-period moving average, but you can see that $29 level is pretty significant resistance, and I wouldn't really do, I would be bullish to neutral on silver. Okay, so maybe a bull put spread, maybe selling a put spread down at 27 or 26 if there's any premium there. I wouldn't necessarily do anything up and out of the money, like a call spread, out of the money call spread or anything, unless we broke above $29. Okay, for silver. But right now, it's still consolidating and is finding resistance there up at $29. Okay, next, let's move over to the bonds because that's where the action is. Right now, we have the long end of the curve, which is the iShares 20-year Treasury Bond ETF TLT. That is our proxy for long-term interest rates. And you can see that we have pulled back off those highs from last week. We look at that rally. First of all, the drop. I mean, we were up at this level about 3 weeks ago, and then we had this big old drop as interest rates spiked. And then as fast as they spiked, down they come with this rally back up to $94. And now we've just pulled back a little bit off of that. But interest rates, what a wild ride right now. If we move over to short-term interest rates on SHY, take a look at this. I mean, rates are really dropping. And look at that big move, the B bottom on the pullback and then a launch. So we will see if this 82 level can be pierced or not. That is pretty good resistance up there, even higher resistance up at 82.5. But we would need to get above 82, which is some moderate midterm type of resistance for short end of the curve. And how that looks on the inverted yield curve up until last week, you'll see that we are dropping to almost new lows where the spread is widening. Again, the 3-month versus 10-year spread, that's what you're looking at here. 3-month treasury bills versus 10-year bonds. Okay, that is what the Fed kind of looks at as far as the yield curves go. And we are widening on that spread. Okay, we thought maybe we might be flattening after today. We'll see if we flatten a little bit, but Friday we dropped back down and the spread widened. Now, what's interesting about this is that the talk of the Fed has changed a little bit. You probably have already been made aware that talk now is more about the national debt and not so much on rate cuts, as rate cuts are being built in. I still have a December target. I think my September percentages are increasing. Okay, but I didn't think I've said since March that we wouldn't get a drop in interest rates or a rate cut until December. And I still that's where I still am, although my percentages for September are increasing. I will say that. So as we look at the economic debt, this thing, you would really need to look closely at this line and see where some of the momentum is. Really since 2000, this thing has been increasing. And then after the 08 meltdown and we got past 2010, we started on a vertical path. It doesn't matter, really who was in office, what party was in office. We have been increasing the national debt, with the exception of recently. Okay. And you'll notice that angle of ascent has increased. Okay. First of all, the angle from 2010 to 2020 was greater than a 45 degree, and that's where things get unmanageable. But then when you skew that even steeper, then it becomes untenable. And we are going to see major problems, and the Fed is now starting to talk about it. Hey, we need to stop spending. That is right now the subtle message that I think will be banged a little louder as we get closer to the fall, but very concerning on this particular chart, as just good policy needs to appear, or we will find out what the bond market has in store for us, and I'm afraid people won't like it. All right. So lastly, moving on to interest rates as it relates to mortgages. Look at this. We have dropped down below 7. That 7 was very troublesome for a while. And look at that. We're about 6.30 now on the 30-year bond as a national average. Plenty of incentives now for home buyers. The one thing that is throwing a wrench in the works is that upcoming NAR implementation, NAR changes that will be implemented. I believe it's no later than August 17th. And home buyers are in for a big surprise when they want to go see a home and they can't get in unless they sign an agreement with an agent. Okay, more on that. You can find lots of news on that on different channels, YouTube or whatever. But I think the settlement is going to create more problems than existed before as it relates to interest rates. So that could really affect existing home sales. As people may want to avoid that and feel they can go directly to a builder and maybe avoid that type of scenario. So we will keep an eye on that as we head into the fall. But that is something I am already got my eye on, is how that NAR settlement, National Association of Realtors, if you don't know anything about that, you can go look it up. All right. But how that will be not only implemented, but managed as we get into the last part of August and then into the fall, as that typically is a slower part of the year as it relates to home sales. All right. So with that, let's look ahead. We have, as I mentioned, we have earnings coming up, and we have over 186 stocks this week, along with some of those economic announcements. So, there's stocks represented here from every industry. We have trucking, we have financials, we have debt, we have food, like Domino's Pizza, and Netflix has its earnings, and American Express has its earnings, and just all over the map. I think this week will be a good little sneak peek at upcoming earnings, as we have a big diversity in the different sectors that are represented here this week. As I mentioned, Goldman Sachs had earnings this morning. Stock is on my quiet list, and it did not move very much at all this morning, which is anticipated. And on the other hand, American Express, we expect a little volatility with American Express. Somewhat different sector. Obviously, American Express is consumer debt. Okay, but that's one thing that I'm looking at as we go through this week and head into the heart of earnings season. So that takes us to the trade of the week, and believe it or not, it is not American Express. It is Netflix. All right, we are keeping an eye on Netflix because right now pricing on the Straddle is, and actually we're probably doing a baby strangle, meaning we're only like $2.50 apart on this strangle. The pricing on this Straddle is going to be, it is $2.50 apart because of pricing. We just wanted to straddle the price on it. And this is expensive. This is about this trade is about $6,000, okay, for the straddle. However, that is a discount on the historical move of the stock, meaning the stock typically moves X percentage, and the break evens on this particular trade are well within that. Meaning, if we get an average move in the stock, we will have a nice profit in the trade. So that is our trade of the week. We're watching Netflix, and they have earnings coming up on Thursday after market close, I believe. Thursday after market close is earnings for Netflix. We will keep an eye on that and come to you next week with the results of that. With that said, everybody have a great trading week. As you can see on the screen, we have a free guide. Okay. Because we're heading into earnings season, I think this is a good time to mention this. A free guide for you to learn how we trade these strategies through earnings season with one of the strategies that I just mentioned, which was a little baby strangle. Okay, that is available from ewotrader.com/straddle. And you can pick up that free guide today. No charge for it. Just go pick it up and take a look at how we use this strategy to benefit and profit during earnings season. So everybody have a great trading week, and I will talk to you again soon. Take care. That